Hi everybody, this is Mark. I wanted to show you a chart here as we begin our class of managerial accounting. This is management control of business, and in order to control business, the team in business develops objectives as to what the business is all about. Then from those objectives, operating plans are developed. And one of the plans that are operating is a strategic plan, and that goes out 5 years. Another part of an operating plan is a budget that goes out 12 months. Those plans are developed and implemented in operations, and then there's a feedback mechanism that tells us how well we're doing in operations. And one of the prime feedback mechanisms is the accounting system, and it records all the activities, all the costs, all the revenues, and everything that takes place. Then the feedback is compared with the budgets, and variances are developed. We find out where we're off from where our plans are, and those variances are fed into people who can make decisive actions, and they can take decisions to change the objectives or the operations, or change the plan even, and in long term they could even change the developed objectives. Several years ago I had responsibility for the finance and planning of a subsidiary of Burlington Northern. This is the Forest Products subsidiary that I had those responsibilities for. And every June and July we developed a strategic plan which went out 5 years, and had to get those plans approved with Dick Bressler, who was our CEO, or the corporate CEO at the time. Then once those got approved, the following October or November we would develop a budget plan that goes out 12 months, and it would take basically the first year of that strategic plan and implement it into 12 separate monthly operations. The development of a strategic plan and the budgets are exciting activities. It's a lot of work, and I worked with the operating personnel and the marketing personnel, and it was a team effort so that we all came up with an agreed upon plan. Now, in the book, one of the control mechanisms that I wanted to show you is it has to do with comparing actual results with budgeted results, which you can see in this Surge Performance Beverage Company, which is in your text in Chapter 1. And there's the variances that result from this activities, and now we have to decide which of the significant variances to investigate, and obviously the 150,000 and the 50 are the two significant variances to get into, but that's one of the things, a decision that has to be made every month as to what variances to get into and find. I used to work with the finance, and not the finance, yes, well, finance too, but primarily the operating and the marketing department personnel to uncover what the reasons for those variances are, and then we would work together as a team to develop corrective action plans so that we could bring the operations, if we can, back in line with the budget, with what the plan is. This is also one of the prime ways you measure a manager, is to see how well a manager manages his operations to conform with the plan. And if he or she is way off, then you have to make a decision whether he or she is not as good as is not doing a good job and needs to be have some measurement way of measuring their success. I guess to be it's a significant operations to view. In managerial accounting, this is a comparison of managerial and financial accounting. Managerial accounting is directed internally rather than externally. Financial accounting is primarily directed at the external market. Managerial accounting may deviate from GAAP. Financial accounting definitely may not deviate from GAAP. Managerial accounting often presents more detail. In fact, almost always presents more detail. Managerial accounting may present a lot of non-managerial, non-monetary information. Managerial accounting places more emphasis on the future in terms of strategic plans and budgets and all of it, and then decisions that the company wants to decide as to where to make, which involve the future. Here's some costs that we'll be working with. Variable costs are unit costs that remain the same but change with total volume. Fixed costs are costs that remain fixed and do not change with changes in volume. Sunk costs are sunk costs. Opportunity costs are values foregone when one decision is selected over another. Direct costs are traceable to a product or to a department. Indirect costs are not traceable, cannot be traced to a product or a department. Controllable costs are costs that managers can influence and control. Non-controllable costs they cannot control. Well, this is the beginning of our managerial accounting. I look forward to working with you. Thank you.